Hey, and welcome to Heinz and Clark's first podcast. We don't have a name, so it's Heinz and Clark right now. I'm Aaron Clark. This is Steve Heinz, and our first podcast is starting on the first snow of the 2021 winter. So kind of a cool start for us.
Maybe not cool.
Yeah, snow stinks. So like I said, I'm Aaron Clark. I've been in tax and accounting since like 2007. Worked for a number of different firms, and then kind of joined up with Steve in 2017, and Heinz and Clark was born to solve the taxing problems of the world.
As Aaron said, I'm Steve Heinz. I've been in this industry since 2009. Got my CPA in 2010, I believe. And worked in government for a while, state auditor's office, which was a terrible job. And then I started my first CPA firm in 2014, and then a few years later merged with Aaron. So yeah, and we're here. I think the podcast, our goal here is to try and make taxes more fun, and also kind of help people with a better understanding of areas that they're kind of looking to learn more about.
So for our first podcast video today, our agenda is going to be talking about the MNCPA tax conference and some of the big points that we learned about actually this week, Monday through Wednesday. There's a variety of updates that happen through this, and we'll go probably a puddle deep today, but we'll cover a wide range of topics.
Yeah, a couple of observations I had from the conference. With it being virtual this year was interesting because, a lot of the presenters were from outside of Minnesota, which I think is a little unique and obviously a little bit more feasible when it's, on Zoom or whatever. And also allowed our staff to, our whole staff, accounting staff watched it and was kind of able to, not waste a full work day, able to get some work done while doing it as well too. So,
Or 3 full work days.
Yeah. And I think the topics I think they had some really good topics, especially with all of the tax law changes that have happened, and even some of the ones that have been proposed or discussed. I think a lot of it is beneficial for our clients, and also there's some stuff that probably our clients didn't care about, but was more for us. So, but like Aaron said, we'll jump into some of these topics, and if you have any other, want some specifics on any of them, just let us know. So.
Yeah, we'll kind of to that, and we'll mention this again, but I'll throw it in here now. We will do kind of a Q&A video so that we make sure that we get your questions answered, because we're not going to dive really deep into any specifics on the topics today. So without further ado, or talking too much anymore, we'll just kind of jump in. One of the kind of looking at the federal side. Two main areas in that are federal business tax highlights and individual highlights. One of the big things that's come out with the CARES Act and COVID is PPP Forgiveness and Expensing. Some of the main things that people probably already know now, but expenses were allowed to be deducted. That was a change from when everything initially came out. The loan, this may be a little too technical, but loan increases the basis in the company so that the shareholders, partners were able to actually take the losses on their personal return. There's a lot more in explaining that gets more technical.
And maybe one thing on that real quick, Minnesota also passed a law middle of the summer, I believe it was, conforming to the federal law that the PPP is essentially non-taxable, or that you can deduct the expenses. So they're supposed to be correcting that themselves. So if you see an additional refund, it's a good chance that that's what it was for. If your return was filed earlier in the year, so definitely something to watch for, and let us know if you don't see that come through. So
actually, what Steve brought up has been a big question. So it's kind of interesting of what is Minnesota doing, and I literally last night got an email from one of our clients that we've been trying to figure this out, and she just got her refund and the explanation And so we didn't have to go back and amend. Everything that we're hearing is you're going to get a letter telling you that they fixed it, or you're going to kind of get nothing. It's been kind of a weird zone, but just so you know, they are finally doing it.
Yeah, and it seems like, because I've heard other clients have gotten a refund and they're like, what is this for? And so it seems like right now this is November 12th as we're filming this, so it seems like this week, maybe last week is when this started to happen, so you should see it soon. So.
Another kind of just small topic, but an interesting one for business owners is the 100% deduction for restaurant meals. It's typically been a 50% for business-related meals that you can expense, and for 2021 they've made it 100% as a way to help the restaurant industry come back from the restrictions they dealt with.
Yeah, and you should note that is restaurants. They talked in the conference that if you get food at a gas station or
what do you use, Casey's Pizza?
Yeah, as an example, so that wouldn't be included. So we have a lot of restaurant clients, so support your local restaurants.
Employee retention credit. So business owners that have employees, this has been a really, from one of the comments in the conference, a really lucrative credit. And for people that qualify, they've actually made it even more lucrative, increasing the credit percentage based on wages. Qualifying for 2021 did get harder as a result of this, meaning you needed like an 80% decline compared to previously a 50% decline in gross revenue, in kind of quarter over quarter, getting into the weeds there. But they did also add a provision. One of the things that we ran into with clients is, what about new clients that started in 2020 or right at the tail end of 2019 that didn't qualify for this originally because they didn't have a decrease in revenue. If anything, they had an increase. It went from 0 to something.
Something more than 0.
Yeah, which is an increase. There was a group of clients that we dealt with that were just kind of out on this credit, and for 2021, they've made some changes on that and allowing you to use 2020 income to qualify for the employee retention credit. We're actually in the process of working with one client, but 2 separate businesses that now qualifies for this as a result. And so it's something to think about, that if you were kind of in this situation, like some of our clients, or you're one of our clients that is in this situation, reach out and we can make sure you qualify and get you credit for it, because the credit is really good. For lack of better saying, it's very lucrative.
And I think most of our clients probably know if they qualify for this, but essentially if you had a significant drop in revenue from, I'll just say year over year between 2020 or 2019, there's also some exceptions for if you were forced to shut down your business because of a government type of shutdown, or like even restaurants when they were restricted on seating or capacity, that they would be eligible as well too. So if you have questions, let us know. We have one of our accounts, Anna, is kind of our guru on this. She's read the text of the bills and helped several clients get the credits and refunds. So
So that's kind of what I had from the federal highlights. I think.
Yeah, I can jump in on
from the business side.
Yeah, some on the individual side. One of the big ones is the dependent care credit. So the max credit goes from $3,000 for 1 kid and $6,000 for 2 kids, up to $8,000 and $16,000, and then that's the amount of expenses that you can claim the credit on. And then the credit percentage also has been adjusted so that you can get 35 to 50% based on income level on that. The credit's also refundable, meaning you can actually get if you have a refund or it takes your income, your tax below 0, you can actually get a refund on that amount as well too. There's also some adjustments with adjusted gross income in that as well too. But in all reality, it's really for just about everyone. It's increasing the likelihood that they would qualify, and increasing the credit that they would have. So if you have kids in daycare, we all know how expensive that is. So.
Yeah, because one of the interesting things that came out of this, like Steve said, the main thing is your credit is more than likely bigger. The amount of people that are able to take it jump from kind of max out at about $43,000. There's some phase out there, but now that initial credit goes, the whole credit, the 50% goes to people with AGI of 125. Doesn't phase out to 185. So I mean, they open that credit up for a lot of people, and so who's eligible for it, what you get, bigger groups, bigger amount, but also interesting kind of planning thing is looking at dependent care benefit through an employer, through a cafeteria plan, whether or not that's as beneficial for you anymore, and also specifically because this credit is now refundable and it wasn't before. So some interesting things to think about.
Yeah, I think it's, when it passed, I mean, a lot of people had already been, enrolled in their dependent care, through their employer. So not like you could have changed a whole lot for 2021, but I think, for us, it's something helping people as we prepare 2021 tax returns to determine, should we change this for 2022 and potentially going forward. So. Yeah, charitable contributions. So last year there was an addition to charitable contributions where you could deduct $300 of charitable contributions if you did not itemize. That's been bumped up to $600. A huge tax savings, but every little bit helps especially if you're in the giving mood. And they also extended where you can take cash contributions up to 100% of your adjusted gross income. That was added last year as well too, and extended. Medical deductions, they reduced the deduction, the floor to be able to take the deduction to 7.5% of AGI, which was 10%. The 7.5% was around a number of years ago, right?
Yeah, and then they introduced the 10.
Yeah. So they're kind of reverting back to that. So child tax credit, that's been increased $3,600 for kids 17 and under, and for 2021, I think a lot of you may know, especially if you've been receiving this, they're actually paying half of that out during the year. So they started in July, so you maybe were seeing this random amount into your bank account from the IRS. It's probably what it is. And something to note on that is that's going to have to be reconciled on your tax return. So if you have been receiving that, when we go to file your tax return, that's going to be information that we're going to know as far as how much you've received to make sure that you get the full credit. So.
And to that, you can have a specific experience in what can be interesting and what's going to be challenging on tracking this.
Yeah, so I actually was eligible for it and received, I can't remember the exact amount in July, but the amount has dropped since the first one that I received. So, if I was looking at it, based on just what I received in July, I wouldn't be, I would have claimed I received more than I actually did, where I wouldn't get the full credit on my return next year. So definitely something to pay attention to.
Yeah, you'll probably see similar, if you're a client of ours or become a client of ours, you'll see probably similar emails to the stimulus checks that went out from last year of us needing to verify what that number actually is. So it is kind of this weird, it's a nice deal, but it just does add some complexity for us going into the tax season.
And then one other thing it was a topic in the conference. It wasn't really a change this year, but the Tax Cuts and Jobs Act back in 2017, significantly increased the estate exemption, or unified credit it's commonly called. Basically doubled it to, it's about $11 million per individual now, so a married couple would be $22 million. There's been talk that might be decreased, maybe back to the original level, maybe even more. and it is going to sunset in 2026, I think.
It's 25, 26, something.
Yeah, so, I mean, essentially the point we're making is that if you have a large amount of assets and you are, of an age where you're starting to think about how am I going to, give these away in a tax, smart manner, now is probably the time because you can utilize that $11 million credit per person. So if you wait until after that sunsets and drops back down, you'll be stuck back to half of that amount. So just something to think about in the next probably year or two. So it's possible it could change next year. That was some of the conversation. So
Yeah, it's one that we've been looking at more and more because it is just such a big difference for clients that are dealing with this issue. And how do we, in some of our conversations, is how do we almost get people to speed up sometimes their thinking on this, because you're talking about, I mean, the dip that they're talking about, what it would go back to is like $5.5 million, but it's adjusted for inflation, so it's somewhere around 6. It's in the 6s. But you're talking about a $5 million per person, $10 million per household. I mean, it's a significant difference there.
mm-hmm.
So it's just kind of been a hot topic as we come to the end of the year.
Yeah, we were meeting with someone yesterday. We were talking about this, and we were talking about people maybe not seeing the urgency for it yet. And the other guy said, "Hey, why don't you just have them write the check now?" So if you're looking at a $2 million estate tax or something, write that check out now and see how real it starts feeling. So. All right, moving on. These are a little bit more Minnesota specific and maybe a little bit it's probably a little bit more business, maybe some personal related as well. There's Minnesota in August, I believe it was, passed a bill creating a Minnesota pass-through entity election. Essentially what that means is a business owner or self-employed person can essentially pay their Minnesota taxes through their business versus having it all flow through and be reported and paid on their personal return. The flow through still happens, you just get credit for the taxes that are paid there. Why would that be beneficial? Well, that Tax Cuts and Jobs Act also created a cap on state and local taxes of $10,000. So between your state income taxes and your property taxes, you can only deduct up to $10,000 if you itemize. If you don't itemize, you can't deduct any of it. So this is essentially a workaround that cap. So if you're paying $100,000 in Minnesota income taxes, before you were probably deducting very little of that, if any. Now you can essentially deduct that full $100,000 on the business return and then get the credit on your Minnesota return for that tax paid. You can only pay the tax on the income for that business, so you can't include, if I have my wife's W-2 income, I can't include that income and pay that through the business as well. It's only on that business income. Really the only downfall to this is you have to pay that income at the highest Minnesota rate, which is 9.85, versus the rate below that is 7.85. So if normally your highest rate was 7.85, now you're paying essentially 2% more, but you're deducting that full amount at whatever your
Probably a 30% rate.
yeah, or potentially a little bit more too.
So I think a lot of our, so if you're a client and seeing this, you should have received an email from us to start looking at and doing some tax planning around this to see if it's beneficial. We put together a newsletter to go out. I think you can link through our website and find it, or not link through. Go to our website and find it. I'll do something nifty at the end of this and show you where you can go find our website. It'll look something like that. But you can find out about that there. If you're not a client and would like to look at this, we'd be more than happy to help you kind of look through that. One of the points that they made at the conference is the IRS was trying to kind of fight this, because really who it impacts is the IRS more than anything. And essentially they gave in, and so they're trying to. From one of the notes that was in the conference, it was almost like they were trying to help facilitate this.
Yeah, Minnesota's also not the first state to do this or the only. a lot of the higher tax states kind of started it last year. I know Wisconsin passed it last year. And then California, I know we have a fair amount of clients in California. California also passed a very similar, actually I think theirs is probably a little bit more beneficial than Minnesota's, but they passed a very similar bill this year as well too. You know, income wise, you know, if your income passing through from your business is 200,000 or more, you're definitely going to get a benefit from it. But it's possible, depending on, you know, the other types of income that you have and what tax bracket you're at. You know, I would say even if you have $100,000 in income through your business, whether that's an S corp or a partnership, it probably makes sense to look at. So the very first tax plan we did for a client on this, I mean, it was like a $30,000 net tax savings. So you know, definitely worth it. So. All right, well, I think we're gonna move on to some of the grants and kind of how Minnesota has been taxing. And we talked about the PPP already, so essentially not taxed at the federal level or the state level. Again, there's some kind of reconciliation happening there. The Restaurant Revitalization Fund, which passed earlier this year, and we helped a fair number of our clients receive that. That was kind of a mad dash for some cash, if you will. That's also not taxable. I believe it's taxable in Minnesota, though, right? Currently.
Yeah.
It's currently taxable from Minnesota, but not on the federal side. So, and as Aaron said, just with similar with the PPP, it also increases basis. So, restaurants who receive that and still had a loss are able to still take that loss. Yeah. Anything else on those?
Yeah, I mean, just kind of in general, and thinking about those, if you got a more state type grant, and if you're in Minnesota, there were a number of those that went around. If it's coming from the state or county, that's going to more than likely be taxable on the federal side and state side. Most of any federal grants that came are going to be not taxable on the federal side, but outside of kind of PPP, the EIDL grant portion of the loan, those aren't taxable to Minnesota, but other ones typically will be, like the Restaurant Revitalization Fund, Main Street Fund. So just kind of.
And it's certainly possible Minnesota may do something similar like they did last year and pass something to make it non-taxable. We're certainly going to be aware of that if it happens, so we'll certainly be letting everyone know. So.
Yeah.
I think that about wraps it up for this topic for today. So watch for our next video. Like I said, we'll a lot of tax updates. We'll probably do some other accounting related stuff too. And remember to subscribe, like, comment. We plan on doing a Q&A session on one of these, so if you have questions or topics you'd like us to address, make sure you put that in there. And I also want to give a shout out to some of our staff. Tran, our accountant, this was kind of her idea from the very beginning. She came up with a pretty sweet proposal that she gave to us while she was an intern at Heinz & Clark. And then our marketing intern, John, for buying all the equipment with our office manager, Lucas, and getting it all set up. And it's pretty sweet. We get to just walk in here and talk. So thanks to them for all their work.
Yeah, because we'd have no idea how to do this.
Yeah,
we're borderline too old for this. For the technical part of it, we're
never too old.
As anybody that knows me will say, I'll just talk. So, but yeah, like, comment, come back for more tax and accounting updates. We'll do the goal going forward would be more one topic that we would release and go much more in depth on, but thought this was a great start as we're coming out of one of our biggest learnings of the year and get some of that knowledge out. If you'd like to learn more about us, and you should want to learn more about us, we're pretty cool. The cool parts might not be on the website, but go to our website, and the tech people tell me that if I do this, they will put the website right in my hands. Like the link to where the website is, not the actual website. You can't do that. I'm not that old. I know that. But it'll be on the internets, I've heard.
And check out our socials. I was told to say that.
Yeah, socials, not social media. Check out our socials.
All right.
We're getting hip.
Cool.